Well, I founded Caleb Lawrence, Registered Investment Advisor, Inc. in 1998 after a brief stint with a major Wall Street firm. Pursuing the independent path has allowed me to serve my community using a non-traditional approach whilst avoiding the compromising relationships that come with Wall Street's business as usual model and proprietary products. Well, there are a number of reasons for this. The equity analyst scandals following the dot-com era were then followed by the accounting scandals involving Enron, WorldCom, Tyco, and others, most recently MF Global, demonstrated that much of the available data couldn't be trusted. Further, the declines in enforcement of existing rules and regulations that pertain to the financial markets have rendered investing in the modern era much more perilous. Well, despite claims to the contrary, high-frequency trading most certainly harms investors and is probably illegal market manipulation based upon existing rules and regulations. High frequency of program trading has also turned the markets into a popularity contest, diminishing the effectiveness of fundamental equity analysis, and now accounts for roughly 50% of exchange trading volume. With an average holding period of something less than 30 seconds, it's hard to reconcile that with traditional long-term buy and hold investing. Well, certainly success can still be achieved using a traditional approach, though the rules of the game have changed dramatically in the modern era. Complements of machine trading, converging asset class correlation, and declining enforcement of the existing rules and regulations that pertain to the financial markets. Well, because of the changing environment, specifically high-frequency trading and unreliable corporate financial data, picking stocks has largely become a fool's errand, hence the random walk theory and the low-cost approach. Positive wealth management requires a detailed and ongoing analysis of the business and economic cycle because you have to have as much data as possible working for you. Unfortunately, a lot of the data that's available is inaccurate, misleading, or just plain irrelevant, and it takes a long time to figure out who's on first, who's on second, etc. Well, classic asset allocation and buy and hold investing for the long term, aka the Ibsen model, has been challenged in the post-2000 dot-com era because, amongst other things, the market doesn't always go up. Additionally, the model doesn't account for valuation correctly, which has been shown to be the largest single determining factor to successful investing. Other glaring flaws with this model include the omission of demographics and the failure to account for a full and complete bull and bear market cycle, which takes about 30 or 40 years.